The VA loan is hands down the best loan for a veteran or service member trying to achieve homeownership. But what about if that veteran or service member is trying to build a real estate portfolio so that they can earn passive income and long-term wealth? In this video, I'm going to break down for you one of the best strategies for a veteran and service member to consider that has a very low cost of entry. I'm going to show you the pros, the cons, all the requirements, and I'm even going to analyze a real deal that is actively on the market today. Before I jump into the video, I have a free resource for you. I have an ebook that I created that will show you everything you need to know around the VA home loan benefit, from how to get your certificate, what are the funding fees, how to use the VA loan to build wealth, earn passive income, and use it multiple times, along with a VA loan checklist for your home buying journey. Click the link down below. Again, it is completely free and it will put it at your fingertips for you to resort back to and just reference throughout your entire journey with your VA home loan benefit. All right, let's jump back into it. So what are some of the benefits to buying multifamily property with a VA loan? The first main one is no down payment. This is similar to when you're using your VA loan to buy a single family home, townhome, or even a condo. When you're purchasing a multifamily property, that's whether it's a 2-unit, 3-unit, or 4-unit, you still do not have a down payment requirement. Another benefit that comes along with using your VA loan for multifamily property is also no private mortgage insurance. This also relays from using it for the other avenues like single family, townhome, and condo, as I mentioned before. Another really good benefit for using the VA loan on multifamily is going to be flexible underwriting requirements. You see, every loan has different guidelines and requirements that go along with it. FHA, for example, would use a debt to income ratio of 57%. And that's how much you can have up to or less. Conventional would be up to 50% or less. But what about VA's requirement? VA actually does not have a debt to income ratio attached to it. They use a little thing called residual income, and they base it off of your household size, the region you live in, and the overall income that you have coming in versus going out. I have seen veterans use their VA home loan that have a 60 to 65 and even a 70% debt to income ratio be able to become homeowners, whether that's for a single family home or for multifamily as well. The other thing that you have are going to be tax breaks. You see, your tax breaks are based on a few different things. When you're a homeowner, you get tax breaks on your primary residence. And when you're a real estate investor collecting rental income, you get tax breaks on your real estate portfolio as well. Well, if you're purchasing a multifamily or multi-unit property with your VA loan, you're actually living in the property and you're also renting out the other units, which means that you're receiving double tax breaks. It's important to talk to a CPA about that, on what all of those different tax breaks are, how they work, but that's just an example of one of the really cool benefits on how that's going to save you money on your overall taxes every single year and just put more money back in your pocket. One of my favorite parts about why it is beneficial to use your VA home loan for multi-unit property is going to be house hacking. House hacking is where you're basically leveraging the property you own as your primary residence and an investment. You're renting out either the other units or the other rooms, if you have a single family home, to help offset your overall monthly payment. So those are some of the pros that I would say are why somebody should consider purchasing multi-unit property. All right, let's talk about some of the pitfalls or the cons to purchasing multi-unit property. As you know, not all things are sunshine and rainbows. So anyone telling you that it is probably lying to you. So I want to be very transparent here for you guys and share with you some of the things to keep in mind of, because they may be cons to some of you guys. When it comes to pitfalls, one of the main ones that I would say some people don't want to have going on in their situation is they don't want to live attached to their tenants, or really just want to live attached to anyone. It's kind of like apartment living. When you own multi-unit property, you know, that person that is renting from you could be, whether it's directly above you, directly below you, they could even be next to you. But some people don't want that, and that's perfectly fine. I think it's something to keep in mind of going into it, or at least before you even take those steps, because it may be a thing for you that is a huge deal breaker, and that is completely okay. Another thing to keep in mind of is going to be maintenance. You see, when you're a renter or you're just renting a property from somebody and something goes wrong, you know, you can just call your landlord and let them know that they need to come fix that. Well, in this case, you are the homeowner and the landlord. So if something happens, that is going to be your responsibility. You can hire a property manager so that way if something does go wrong, your tenants contact the property manager. But regardless, the expense of that maintenance is going to come back on you. Some people look at, buying real estate and owning real estate as they think about all of the negative things that go to it, like something's always breaking or something's always wrong. And that's just not true. Things do happen. Don't get me wrong. I don't want to say that they don't, but it doesn't happen like people make it out to be. And the funny thing that I've realized is a lot of people that talk about all of the things that can go wrong with owning real estate and how all of the things that go wrong are with your maintenance and something's always breaking are typically people that don't own real estate and have never owned it. And it's kind of surprising to me. I own a rental property. I've had a couple things go wrong and break on it. I've had to take care of it. Either way, it's still one of the greatest investments, and I wouldn't change paying for that maintenance for not owning real estate. Another thing I would say to keep in mind of as a potential con is a lot of homes that are going to be multi-unit or multifamily property are going to be in older neighborhoods and typically going to be older homes. And the reason for this is because there aren't a lot of developers or builders that are constructing multifamily property. It's not that I think that those are bad situations to be in. It's just something that you want to be aware of going into it. Before I jump into how to qualify and buy multifamily deals, I got to ask, have you gotten any value from this video so far? If you did, do me a huge favor, please hit that like button, because this channel is created to help educate veterans and the real estate industry around the VA home loan benefit. Let's get back into it. Okay, so how do you buy multi-unit property? The first thing that you need to do is get connected with a VA loan specialist. Guys, I'm telling you right now, this is going to be uber important. You don't want to just work with any lender or any loan officer. The reason for this is because there are so many different loan products out there. They all have different requirements and things that go along with them. And what you don't want to do is be working with somebody who just does a lot of a bunch of things. If you want to work with me and my team, we specialize in VA loans. This is literally 100% of our business, and we have helped veterans nationwide. So no matter where you're located, me and my team can take care of you in your market and also connect you with other people in your market that work with veterans as well. So when you're working with your VA loan specialist, what they are going to do for you is get you pre-approved. This is going to be taking a look at a loan application, taking a look at your income, your assets, your liabilities, and your credit. What you don't want to do is just get pre-qualified. A pre-qualification and a pre-approval are two completely different things. They are nothing alike. The pre-qualification is just an application and really pulling credit, where a pre-approval is the application also pulling credit and looking at your income documents, your asset documents, your overall liabilities, and doing a full analysis on the underwriting system to make sure that they have confidently qualified you on the amount that you're trying to purchase. So now that you have your purchase price comfort zone, your payment comfort zone, you can now go out and connect with a VA knowledgeable real estate agent to help you look for properties. So why do I need to work with a VA knowledgeable realtor as well? Well, as I mentioned, the VA loan has requirements that go along with it. And in the VA guidelines, there is a chapter called minimum property requirements. And that is a chapter that is basically designed for the real estate agent. That chapter is going to show you everything that the property can have and cannot have going on with it. And the last thing you want to do is be searching for property with someone who does not realize that maybe the properties that they're showing you aren't even able to be purchased with the VA home loan. So that's why you want to connect with a VA knowledgeable realtor specifically, is so that way you can make sure that they have an understanding of what those minimum property requirements are. This is going to save you a ton of time. The next thing that you are going to do once you find a property with your VA knowledgeable real estate agent is you're going to analyze that deal. And this is where you're going to bring your lender back into the fold, and you're going to have your lender look up what your monthly payment would look like on that property. The next thing that you're going to do is work with your realtor to find out what the property is either A, currently receiving in rent, or B, what the property would be projected to receive in rent. The reason for this is because now you can get an idea of how much money you have going out for the property and how much money that property is bringing in each month as well. This helps give you a better understanding of your overall budget for the property. The next thing that you want to do is you want to have an exit or transition strategy. So an exit strategy is for typically how long you plan on keeping the property and when you plan on selling it, and for typically roughly what for. In this case, a transition strategy would be you living in the property, and then how long later do you plan on moving out of the property and renting out the unit that you were living in. You see, the VA only requires the veteran to occupy the property as their primary residence for 1 year, which means at the end of 1 year, you can transition out of the property, rent out the unit that you were living in, and if you wanted to, you can even go and buy another again down the road. If you want me to do a full video on how to use what's called second tier entitlement, like this video. If I get this video to 50 likes, I will do a full video on second tier entitlement, how a veteran can qualify to use their VA loan and have multiple VA loans at the exact same time with zero down. So like this video, share it with other veterans, and I will do a full video on that for you guys. The next thing I'm going to show you guys is let's analyze a real deal. I jumped online and found a 2-unit duplex here in San Antonio where I live that is listed for $410,000. And this property is active and live right now. So this is a legit deal. I didn't fabricate anything for you guys. I noticed that it's a 3-bedroom, 2-bathroom per unit. What I also looked up is interest rates. What I wanted to look up is what is the national average interest rate for a VA 30-year fixed loan as of today. And what I came up and found was the rate was at 7.25%. So I did our $410,000 loan amount. Now, keep in mind on the loan amount, if you're not collecting VA disability of 10% rating or more, then you will have a funding fee. So it will adjust your monthly payment a little bit. It's not a big change at all, but I just want you guys to be aware of that. I'm not factoring in a funding fee in my scenario just for simplicity, because there are many different funding fees that go along with the different scenarios, and that we'd be here all day creating it. So at a $410,000 loan amount at a 7.25% interest rate, our principal and interest payment came out to $2,796.92. The next thing I looked at is our property taxes, and on this property, it is going to be $523 per month. Our homeowner's insurance came out to $310. And then HOAs, this property is not in an HOA, and it is a zero amount here. Before I jump though, HOA is not super common for multi-unit or multifamily property. It is actually a little bit more rare that a multi-unit property will be in an HOA. I have seen it happen though. I don't think it's something that's a complete disqualifier, but you want to know what your HOA payment will be, because that affects your total monthly payment and obligation on that property, no matter how big or how small it is. And our total monthly payment for this property is $3,629.92. So now we have our total monthly payment. Guys, I think it's important that you comfortably can afford this payment yourself, because if there are ever vacancies on your property, you want to make sure that you can afford to make this payment yourself. But now we have our total monthly payment, right? The $3629.92. What about our rental income? The projected rental income for this property per unit came out to $1,800 per month. And when you subtract the $3629.92 from the $1,800, that means that the amount that you will then be paying each month is $1,829.92. That's almost a completely 50-50 split between you and your tenant for this particular deal. I think that's a slam dunk deal in my opinion, because I've seen a lot of multifamily unit or multi-unit deals that veterans are considering buying, and the obligation that they're paying for the other unit, let's say it's also was a duplex, the obligation that they were paying was $300, $400, $500 over what they were renting it for. It just makes my exit or transition strategy harder, because if I can only rent out each unit for $1,800, well, now I have a $300, $400, $500 obligation that I'm paying each month myself. Again, it's not that I think it's a deal breaker. It's something that you want to be aware of going into it to make sure that you can afford to cover the difference. In this situation, with it being nearly 50-50, here's why I think it's a great deal. When you're living in the property for 1 year, what do you think is going to happen to rental rates a year from now, or even 2 years from now? They're going to go up. Rental rates are projected to continue to go up on average of about 8% year over year, which means that this property will probably be able to be rented for more than $1,800 a year from now. So a year from now, you will probably be cash flowing this property. And obviously, as time goes on that you own the property, the difference between your payment and what you're renting it for is going to continue to get wider because your payment is here. But if your rental income is continuing to increase over time, this is all cash flow now. So that's why I say this is a really great deal. The next thing I want to talk to y'all about are closing costs. So closing costs on this property, I broke down across a couple different factors. The first one is going to be down payment. As I mentioned in the beginning of the video, the VA loan for multifamily, or really for all of them, are going to be $0 down. The next one is seller credit. I did not factor in seller credit. Seller credit is something that you would negotiate into the deal when you're making an offer on the property. So in this situation, though, I did not factor in seller credit, more for the simplicity of this analysis. So that's $0. Rate buy down, I did not factor in any rate buy down as well. When I used the interest rate of 7.25, that was based on the national average. So that's $0. Closing costs, this is for things like title, escrow. This is for preliminary title report. This is for things like title insurance. This is for collecting upfront your property taxes and homeowners insurance to be held in escrow. Your closing costs will come out to around $8,500, which means that your total due at closing would be at about $8,500. If you were doing this deal with a conventional loan, you'd be putting 5% down on top of the $8,500. If you were doing this with an FHA loan, you'd be doing 3.5% down on top of the $8,500. The VA loan is allowing you to purchase multi-unit property, in this case, a duplex, be able to rent out the other unit while you live in one with no money down and only $8,500 out of your pocket. This is my breakdown for y'all on why veterans should consider using this strategy to build a real estate portfolio, build passive income and long-term wealth. If you guys got value from this video, remember, please hit the like button. If you want to learn more about the VA home loan benefit and check out some of my other videos when I post it, consider subscribing to the channel. If you want to connect with me, if you want to learn a little bit more of a breakdown for your unique situation, whether you're trying to buy a house in 1 month, 3 months, 3 years even, I can help you with that and do a full analysis and a breakdown for you guys. Just click the link in the description down below. I appreciate your time. I appreciate your service, and I pray that you guys have a blessed day.